Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. It's Monday. It's July 11th. Welcome to the second week of July. Now, as you can see here, this is our full week, our first full week since the 4th of July holiday. I believe the market is now in full swing again, as much as it could be in the summer. And this is not a traditional summer because there's a lot of factors involved. There's a lot more volatility. This is not a listless, sleepless summer that most of us are used to. Now, it's about 7:46. The market's going to open up in a little bit less than 2 hours, about an hour and 44 minutes. And this is not too surprising to see the market off a little bit. First of all, with the daily range being in about 600 to 700 points in the Dow, 145 points isn't much. And the swings have been wild. And actually, it's been really beneficial to see the market open lower and go higher. That's a fairly bullish sign. Now, we've got a lot of things on the agenda this week. Let's start off with the big reports and we'll go from there. So first of all, just to give you an idea, we're starting off the week fairly neutral. The market will have a chance to show itself. We do have Fed speakers, so that's going to be something to keep an eye on. And again, the focus will be whether they're more confident in the economy or they think we're going to be going south. Now, on Wednesday, we have that CPI. Now, if you recall, the CPI last time around, let me just show you what it did. Last time the CPI came out, I want to kind of connect the dots for you a little bit. Let me go to the Dow Jones. The last time this dreaded CPI came out, the market did this right here. See that little bounce that took us all the way down? The CPI came out at 8.6, and it was shocking. Now, what investors, traders, and everybody else and their mother, including all the monkeys, are going to be looking at, I'm just messing around, is whether this number is going to be 8.8 or it's going to peak out at 8.6. The other major factor is the year-to-year ex-food and energy. This is the core CPI. And last time it was 6. I'm hoping that the number is going to go lower. If it goes lower, this is what the Fed looks at. They look at the Fed at the year-over-year ex-food and energy. That's called the core CPI. And I'm hoping that this number does go down. If this number goes down, then it could be, there's a good chance we'll peak and the sentiment will change. On a year-to-year with food and energy, I don't think the number is going to go down, but I'd love to see another 8.6 instead of 8.8. The bottom line is the market's going to see whether or not we're going to be taking this number out or not. It's going to be very, very important. So expect a lot of trading action. I don't know why, but I can't speak today. It must be from traveling to Fort Lauderdale over the weekend. I don't know. But anyway, as you can see here, we've been fairly choppy, and this number is going to have a major impact potentially on that bond market. So let me just kind of give you a couple of scenarios. If this number is higher as we predict on the year-to-year, and if it's higher on the core, then the bond market will say we're in a recession, and the odds are we'll probably stay in this range, because if we're in a recession, the Fed won't raise rates. But if the number is weaker, if it looks like it's going down, then the Fed will say, hey, we're on the right track and we can stay, the economy can sustain itself. So I believe this number is going to be counterintuitive. In other words, if the number is really high, if it's showing that we haven't peaked, then the Fed is going to be very gentle in raising rates, because then 2 quarters of negative CPI moving higher, that's a recession. And if we're in a recession, sorry, I'm going back and forth, but it's important that I show you how these 2 things intertwine, or 3 things. The Dow Jones, this, and the bond market. The key here is to give you analysis so you can understand how it all works together. So if the number is really rotten, that means there's a higher chance we're in a recession. And if we're in a recession, then the Fed will not do much to change rates, and there's a good chance the tech stocks will stay firm. But if the number is really medium, or if it looks like we peaked out, then the Fed can say, well, it looks like we're taking the proper steps to fight inflation, and we're going to continue putting interest rates because the market can withstand it. Inflation is not going higher. So I think that there's a fine line right now between recession and just a tough time for the market, and how the bond market is going to react. So keep an eye on these numbers. And again, if we're at 8.6, that means we haven't gotten higher. If food and energy drops, that means we're going lower. If the number keeps going 8.8, then the Fed will say, wait a minute, we are definitely heading towards a recession and we need to back up. And that can actually be counterintuitive and cause the bond market to go higher. So keep your eye on the bond market, especially this week, in light of all of these gyrations and the CPI, because the CPI can be very, very, very instrumental. Now let's talk a little bit about global economy and kind of reinforce what we just discussed. Worries over the threat of a recession and COVID outbreak. Everybody in Florida, folks, I'm telling you, people are getting COVID again. I don't know what's going on, but this new strain is supposed to not be it's supposed to be kind of mild, but it's supposed to be highly contagious. My mom is getting over it. Matt, my assistant's getting over it. A lot of people are getting it. And these are people who are fairly careful. Europe's shared currency, it's at its lowest level in 20 years against the US dollar, hit by worries over possible recession and the surge in the greenback as the Federal Reserve raises interest rates to combat inflation. Remember, when interest rates go higher, the US dollar buys less with it, so it naturally goes higher to compensate for it. So it's not going higher because of strength, it's going higher because you can buy less with its current value. Understand the difference between the two. Japan's governing party and its coalition partner scored a major victory in balloting on Sunday, which came 2 days after the assassination of former Prime Minister Abe. Not a very, very good start to their voting. Technology shares fell after market regulators in China fined companies for not reporting past transactions. I wanted to say past transgressions. As required, e-commerce giant Alibaba tumbled 6.8%. Tencent Holdings lost 3.2%. You got to be careful with these Chinese companies, especially right now. China reports its April-June growth data on Friday, their GDP, and update on inflation is due on Wednesday. That's the CPI report that I was talking about. Investors are also watching for upcoming corporate news. Let's talk a little bit about that. I got you covered there as well. We've got 3 big reports this week, and it's not an official cycle yet, but we've got 3 reports coming out, and these are big. You've got bank stocks, healthcare, and airlines. So it's a triple whammy. On Wednesday, you've got Delta reporting. Last year, they had compared to last year's loss of $1.07. They're looking at revenue of 87% year over year and 6.4% over second quarter 2019. So they're looking for 1.64 cents, $1.64 instead of $1.07. On Thursday, you've got JP Morgan. That's going to be big report. And they're expecting 2.94 cents per share, down 22 cents for year over year. And revenue up 6.7% higher. Then Friday, you've got United Health, and they're looking at $5.20 per share, 10% increase, and a 14% revenue. I'm expecting more upside for healthcare, so keep your eye on healthcare stocks this week because they are looking pretty good. Now, this is going to be very instrumental because last time we had the CPI, energy market fell from the sky to the last spot. So remember, if we're in a recession, energy doesn't do well. But if we're in just a downturn, well, energy can do very well, especially in a war. So the Wednesday CPI is going to have a very big impact on the energy market and something we've got to keep a very close attention to. Because if we do confirm we're in a recession, I don't see a lot more upside for energy. But if this is not a recession and just a typical inflationary environment, then there's a chance we'll have more upside for the energy market. So this Wednesday's report is going to be very instrumental. Again, we're looking to see if the year over year is above 8.6, and we're looking at year over year ex food and energy, which is interesting because they're looking for a lower year over year, which means minus food and energy, we might have peaked out. It'll be very interesting to see if it's 5.8 or if it goes higher, or if the core is stable, and if the regular CPI is higher. If it's 8.8, it's not going to be great for the market. But again, keep your eye on the sectors and whether or not energy starts moving higher on a month-to-month basis. This is cumulative. Cumulatively, we're in a very interesting spot right now. Energy is still leading, consumer staples and healthcare. Cumulatively, I like these 3, but on a month-to-month, holy moly, you've got healthcare, consumer staples, and then you've got consumer discretionary communication and technology. So you've got defensive and you've got speculative knocking at its doors. And it'll be very interesting to see which wins, and a lot of that is going to be dependent on the CPI, which is why I don't want to make too many decisions early on in the week. Now, speaking of healthcare, let's look at the charts. Now, I showed you last week how healthcare and how consumer staple are gearing the most upside. Look at the last peak we had. This is the last time before the CPI came out, and this is what happened when we had the CPI, which is why I'm saying let's be careful. But it looks like we're back there with healthcare, and consumer staples looks like we're almost there. Look, not too much, but look at the rest of the sectors. Look at communication. Look at the slope there. Look at consumer discretionary. Look at the slope there. Everywhere you look, there's a huge slope. Look at basic materials. I mean, 88, 75. Look at industrial, 97, 88. But look at healthcare, 132, 133, 73, 74. So these two sectors are coming back right now. What I do like about all the other sectors, or most, is they're in a nice congestion right now. And this congestion looks like it can rally. Not sure about energy. Energy's a big question mark till Wednesday. But the rest of them, not the rest of them, but most of them look kind of stable. Technology looks stable. Real estate looks stable. Financial looks stable. They don't look like they're really moving higher, but they look like they're basing, which is a good sign. So if the core CPI can be 5.8 or 5.6, and if this number goes down, there's a good chance the stock market could rally. Remember, it's a fine line right now between inflation, recession, and the market starting to look ahead. And we're kind of in between these three spots, and we'll have a much better idea of where we stand after Wednesday's CPI. There's more reports there, but I don't really want to get into them till we have CPI, because that's going to give us a good indication of where we stand. Keep your eye on the bond market. Keep your eye on volatility on the VIX, very important. And I'd like to see it break this low. And volatility, bond market, and energies. I want to see if energies start rallying again. If we're not going to be in a recession, energies will rally. If we're going into a recession, energies are done. So energies, volatility, and the bond market, and keep your eye out on these reports, the yearly core and the year-over-year regular. Month to month, nobody really cares about. I'm just being honest with you guys. That's noise. No, just a quick reminder for you guys. My next alpha rotation alert is going to be issued this week. Now, I'm excited to see what the system expects to be the strongest and weakest area of the market over the next 2 weeks, especially in light of the CPI. The strategy is super easy to follow, and it includes a built-in hedge. With the type of market we're in right now, folks, I believe being only long or being only short is a huge mistake. I mean, I sincerely mean that. It's a big mistake. You want to be hedged right now. You want to be in a dynamic position that has a built-in hedge, can protect you against this crazy volatility. What if the CPI is awful? What if it's really great? You want to get in on this. If you want the details of the strategy, and I bet you do, get this trade as soon as you're ready. Make sure to click the link below. It's waiting for you right now. Get the trade as soon as it's ready. It's coming out today. It's not ready for you right now. It's actually coming out later today or tomorrow, but it'll be there. Follow the link below. Check this out. You want to get in on this right now. Bye, guys. Comments, love letters, support at marketgeeks.com. I want to hear from you. There's a really good chance the market bottomed out about a month and a half ago. And this CPI, if it's lower, it'll tell us that. It's some really big clues coming this Wednesday. Don't miss out, and stay with me the rest of the week. I've got a lot of stuff for you this week. Bye, guys.